Okay, so this video clip, we're going to take a look at the capital asset pricing model again, and we're going to incorporate in a dummy for the effect of an announcement or a shock event. One recent example of that may have been Apple on the 27th of February 2024. Apple announced that they were going to leave the car making projects that they had been involved with for a number of years. And I suppose for some investors, that may have been perhaps bad news in the sense that Apple, we know, has been transformative when they enter new sectors. When we take the example of Apple Watch, its sales dwarfs the sales of any other watch manufacturer, which is sort of incredible given how quickly it introduced that new segment into the market. And the capacity of Apple to become another Tesla in some respects, or to challenge Tesla, definitely was there, but they have pulled back from that. And one might imagine that that may have caused some negative impact on the returns of Apple. It may also have been good news if the Apple project had been absorbing a lot of investment and it was viewed generally as non-performing. Then announcement of cutting or scaling that back or completely halting the project may in fact have been good news. So we would like to determine potentially the effect of that, and was there any kind of statistically significant impact on the returns of the announcement. Okay, so it's basically an event study, but we're using a dummy in the capital asset pricing model. So largely the mechanics here for doing this in Python using Google Colab. Now, I've left a link here, video clip, to previous video, which makes use of Aldo Dector's capital asset pricing model. And I go through that a little bit, and we're going to use quite a lot of the Aldo Dector code in setting up the capital asset pricing model here in this instance. The main difference we'll introduce is we add a dummy variable, which will be a series of zeros and then an event window of ones around the date of the announcement. Okay, so, but I am following closely Aldo Dector. I do make a couple of modifications. The major one relates to the override, the Y finance package override. So the pandas reader, we're not going to make use of here. We're just going to rely mainly on the Y finance syntax for importing into data into a project. It might also be worth explaining a little bit where we're getting our data from and how. Well, we're going to take our data from Yahoo Finance for Apple, but we're not going to download directly to a CSV file and incorporate into the project. In fact, we're going to scrape or pull the data in using APIs that are curated with the Y Finance package. This has been developed by Rana Russi, and he's left a full suite of instructions how to draw data or take data directly from Y Finance, including fundamental data like balance sheets, profit and loss, option chain, and so on. So that's quite a significant package and of no cost, right? So that's also attractive, other than watching some ads, perhaps, right? Okay, so if we go back into our code artifact and come down, we follow the approach set out, other than I modify Aldo Dector's code that we don't use the pandas data reader override for YF. In fact, the data comes in using Y Finance syntax only, right? So we set up, we import in our libraries for graphing, Seaborn, stats model, also for doing some regression analysis, OLS regression, pandas for data manipulation, NumPy for multi-array dimensional operations. Okay, and then we set out this helper function or user-defined function, very much in keeping with Aldo Dector, except I modify ever so slightly the code. We will output a CSV file as well, and so we can save that. Delete this one. We can remove that for a second. We'll see what happens when we execute our code. And then we set up import in the Apple stock price and the S&P 500 index. And then we use a log difference function to obtain the daily returns. And then we take those returns and we regress. So we take the daily returns on the S&P 500 and regress on the Apple stock price. I'm going to leave out for the moment the risk-free rate because I'm just going to assume it gets absorbed in here and into the constant. And then we add a dummy into our variable, the shock, which is a series of zeros for the date, that for the end date, start date to the end date, and ones around a window that will define for the shock. So the date of the announcement for Apple, the shock date was the 27th of February, 2024. So 6 days before and 6 days after, including the shock date. So that's 13 days. There will be a series of ones. Okay, now we will take account of weekends. So that will, 2 weekends would remove 4 days from, if we have a 12-day, 13-day spell, that's 2 weeks. So we're going to touch 2 weekends. So that will remove 4 calendar days as well. Okay, so it's a little bit of the small detail around setting up the window. So if we run this function, set out the function, and then bring in, spell out the specific dates. Now we can change the name of the stock and the name of the individual stock and the market index. So all that we can later, once we set out the function, we can just simply substitute in for different stocks and different market indices to run this type of event study. So when we run that analysis, we're importing in our stock price data, our market index data, S&P 500, between January 1st, 2020, June 16, 2024, and the shock date of the announcement was February 27th, when Apple announced it was pulling out of its Apple Car, Apple Car manufacturing or development, not CarPlay, just not the app, but the actual project to develop an Apple Car. And what we observe is we have the daily, we get a scatter plot where we have the market return set out against the individual stock price returns. So each of these dots is a specific day. What was the market return? What was the individual stock return? Then using the capital asset pricing model, we have the line of best fit. And then using the stats model, we also have the regression output for the model. So I need to come back here in this window. We have a constant estimate. We have the market. This is the coefficient. This is the beta coefficient. And the shock here is negative and is statistically significant. Now, like a lot of event studies, if you change the window, you might get different effects. So it's quite volatile. So if we change this to 2-day window and run again and look at our results, we don't get, well, it's a negative effect, but it's not statistically significant, right? So the p-value is 0.5. So there's we run the risk. There is a statistic. There is a 59% chance that this value could be 0. This coefficient on the dummy could be 0. So it's not it's negative, but it's not statistically significant. If I change the shock window to 3 days and come down, it's still negative, but not statistically significant. If I change the window to 4 days and run again, it's still negative, but not statistically significant. And if I change to 6 days, so 6 days before, 6 days after, and 1 day on the day of the announcement, that's 13 days in total, it is now statistically significant. So it does seem to have a depressing effect, but then statistical significance only guaranteed to be over that 13-day window. When we have 13 days also, the number of ones is going to straddle 2 weekends. So then we're also removing 4 observations, or 4 days cannot be accounted for in that 6-day window. Okay, now we could conceivably look at, develop or apply this model to the other types of event study. So for instance, we might be curious to see what was the effect of the announcement of the CFTC on Bitcoin. There was an announcement that CFTC on November 21, 2023, they announced that Binance was going to have to pay a fine of 1.35 billion. So it had to disgorge 1.35 billion and pay a 1.35 billion civil monetary penalty, and also oblige Zhao CZ to pay 150 million in civil monetary penalties. This may have represented a hardening of attitude of regulators towards the crypto assets market. And I was curious to see what was the effect of this announcement on the value of Bitcoin relative to some kind of market index. So again, using the same approach as we have above, I changed the representative, the individual asset to the Bitcoin, and then we'll link that to the S&P 500, and the shock window, the shock date is the 21st of the 11th, 2023, and a 6-day window. And just to see, is there any noticeable effect in terms of the value of Bitcoin falling relative to market index, right? So actually, in this instance, what we're going to find is that the R-squared is only 17%. So it's not a strong model in that respect, and only a small proportion of the variability in Bitcoin can be explained by the variability in the index. That was unlike Apple, where we observed that the R-squared for Apple's return relative to the market was 64%. So the model is a bit weak in that respect, and that's what we might expect. The effect on Bitcoin is not statistically significant. So the announcement on Bitcoin, the announcement that Binance was taking a fine, doesn't seem to have a material effect on the value of Bitcoin. Now, in some respects, the capital asset pricing model it doesn't provide us with, we don't have the lineage or maybe the theoretical underpinnings to support the model, but we are curious to look at how Bitcoin, what Bitcoin's beta is relative to the market, and it is roughly 1.16. That is statistically significant, but that is not really well supported by the low R squared here. We could do the same again, but using NASDAQ, because NASDAQ is more tech orientated. So we take the NASDAQ index, scrape it from Yahoo Finance, and run the model again. Now, again, I shouldn't have put here. Yeah, this PDR override, that doesn't work anymore. So let's just take that out and go back to, let's see, data PDR. Okay, that's, let's take the, let's just use the function itself. So we've already defined, so the first cell, we've actually defined the function, right? The second, again, the same. I've made the adjustment in the code from Aldo Dector. On the third segment of code, let's just remove that. But I do want to use this, so we can take the example, Control C, and remove. That's out. So again, start the project, start the code again. The first sets out the function, the code, the helper function. And we observe the effect on Apple, and we have a regression output for Apple, the beta, the shock. Then we can come below here and just Control V. And so we don't have to, in fact, use input the user-defined function again. It's already been done. We're just going to set out the effect of Bitcoin. We're looking to draw in the Bitcoin and perform a capital asset pricing model with a 6-day window for a shock window. So it's the capital asset pricing model with a dummy. And we have the output for that. And you can see here, we're getting a low R squared, but there is a statistically, the beta on the model is statistically significant, but the shock is not. So no discernible effect in terms of depressing the CFTC enforcement action, didn't have any impact on the value of Bitcoin. If I replace the S&P 500 index with maybe NASDAQ, the NASDAQ index, go find that. So I'll go look for the NASDAQ 100 ticker. It's NDX. Okay, let's come here. So the ticker is NDX, more tech companies involved, and come back into our capital asset pricing model with a dummy and replace the index, the S&P 500 index, with the NASDAQ index and run our model again. What we observe is a beta coefficient close to 1, no statistically significant effect of the announcement of the enforcement action on Binance, on the value of Bitcoin, and perhaps that's what we might expect. Anyway, we can change the dates. Maybe let's go with a 4-day window. Still no impact, not statistically significant. The p-value is not sufficiently low. The t-value is too low, should be 2. We have a 86% chance that this actually could be 0. Let's change the window down to maybe, let's go 10 days. So that's 10 days before, 10 days after. Again, no statistically significant effect of the enforcement action by CFTC on the on the value of a Bitcoin. So we're using, if you like, the capital asset pricing model here as a counterfactual to try and see what normally would have happened. But the effect of the announcement of CFTC on Binance may have been perceived generally as a hardening of the regulatory stance on crypto assets, and no noticeable effect on Bitcoin. Okay, I'll leave it there.